I'm John Hanna for CDTV.net in New York, and we have Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Good afternoon, Dirk.
Good afternoon, John.
Dirk. All right, so let's try to see some good news out there. Do you have anything for us?
Well, the one thing we have is, we're pretty much now finished with the second quarter earnings season, and we've got 97.2% of the reports in as of last Thursday, constituting 99% of the total expected earnings. So, I think we've got a pretty clear picture of what's going on.
Is it good or bad?
I think it's pretty good. Now, if you look at the overall total net income for all the 500 companies or the 486 companies in the S&P 500 that have reported, we're up 12.0% over a year ago. Well, that's down from the 17.6% rate of the first quarter. All of that is really due to just the financials, and even within the financials, to pretty much one stock, which is Bank of America, which had a $12 billion swing between what it earned last year and what it lost this year, mostly related to the mortgage settlement. They've got additional problems, but I won't go into that. So if you exclude the financials, we grew at almost identical pace, actually up slightly at 19.75%, up from 19.74% in the first quarter. That's pretty healthy, and we also had pretty decent revenue that was reported. So it's not just the bottom line. We are seeing some strength on the top line as well, up 9.4 or up 10.9% in total. That's up from 8.7% growth in the first quarter. And again, if you exclude the financials, we're up 11.3%, up from 9.45% in the first quarter. You just had consistent positive surprises. The ratio of positive surprises to disappointments was 3.49 to 1. And on the revenue side, it was 2.54 or 2.49%. That's a very strong reading, particularly on the revenue side, because on revenues you really don't have anybody who really meets expectations. I mean, it's always a little high or a little low, but the median surprise was 1.81% on revenues. It was 3.13% on earnings. So half of the companies reported at least 3.13% higher than expected. And basically 70% of all companies reporting beat expectations. That's a pretty healthy number. Now we are expected to see a bit of a slowdown when it comes to the growth in the third quarter. We're slowing all the way down to just 2.1% for EPS, or excuse me, reading the wrong column there. It's going to be 12.6% is the current expectations for excluding financials, and 12.9%, in total. So you get a little bit of a rebound, and so I think that's still quite healthy. And obviously, we're not what we were growing in the first quarter, but and given what the market has been pricing in, that's far from the end of the world. Revenue is expected to grow at 6.3% in total, or 6.6% if you exclude the financials, and that's quite healthy. Now we have had a bit of a deterioration in the full year numbers for the expected growth for 2012 in response to the slower growth economy. But we're still looking at 9.5% growth over 2011 levels, and 2011 is expected to be 15.9% higher than 2011. So it's a consistent growth story. But if you go back a month, we're looking at having total growth of 13.9%. Now, about 3/4 of that decline in expected total net income for next year has come from the financial sector. I mean, there's a lot of problems out there, potentially spillovers from the Europe situation and bad debt situations in the financials. And, it's an area I would be personally a little bit nervous about. But, you're still talking about total net income expected for the S&P 500 to top the 1 trillion mark in 2012. 1 trillion and 8 billion is expected. That's down from 1 trillion and 48 billion about a month ago. But the PEs are extremely attractive. Again, based on the close as of last Thursday, which is actually about where prices are right now, because we had the big fall on Friday and then a rebound in the past couple of days. You're talking about 11.8 times for 2011 earnings and only 10.8 times for 2012 earnings. That's pretty good. And I would also point out that even though the total net income is coming down for 2012, there are still more analysts that have raised their estimates than lowered their estimates over the last month for 2012 earnings. So, I would say that, by and large, we're looking at a very solid earnings picture. There's been a little bit of deterioration, and the reason ultimately that you buy a company, and that's what a stock is the partial ownership of a company, is because it earns money. And if the earnings are growing, then over time, the company should become more valuable. And so, especially if you can pick them up at very low valuations. And the other reason you buy stocks is they provide dividends.
Now, is there like tools out there? Because, coming from like a regular investor, let's say for example, a listener might have $1 million and they don't know all of that stuff, with regards to looking at the receivables and the liabilities that they have and the current market capitalization with regards to the whatever inventory that they have. Is there like a tool within Zacks.com?
Yeah, there's something in Zacks called the Research Wizard that allows you to screen and create variables like this.
There you go. Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net.